The Federal Reserve is scheduled to cut their Fed funds rate in just a few days at their September Fed meeting, but don't expect mortgage rates to drop drastically just because the Federal Reserve cuts their rate. You see, right now, the market is pricing in that the Federal Reserve will cut their Fed funds rates by 25 basis points, and that's already baked into mortgage rates. That's why we've seen mortgage rates come down over the past month or so. Right now, Nephew here in Vermont currently has the best 30-year fixed rate mortgage that I've seen at 5.875%. Now, if the Federal Reserve cuts their Fed funds rate by 25 basis points, we actually might see mortgage rates tick up slightly to around 6 to 6.125% for the absolute best mortgage you can get out there. And the reason why they might tick up slightly is because the market is currently pricing in a chance of a 50 basis point hike, right? So some investors are gambling that the Federal Reserve is going to cut their rates more than 25 basis points, which would bring mortgage rates down lower. Now, if they do opt for that 50 basis point cut, I think we will see mortgage rates drop even further from where they are today. And maybe what's more important than the actual mortgage rates or than the actual Fed funds rate dropping will be Jerome Powell, what he says in his press conference and when he answers questions from the press. The answers to those questions in the speech that he gives could shift markets one way or another. If he's signaling that they're going to continue to cut rates throughout the rest of this year and into 2025, then we could see mortgage rates fall. If he's signaling that they're going to be very cautious, maybe cut once and then take a break and pause, see how the market reacts, and then cut again, then I think we could see mortgage rates tick up slightly. So we're going to talk about all that and talk about what the market is pricing in terms of rate cuts to help you make the best decision with your home purchase or home sale. Before we get into it, my name is Liam O'Reilly. I'm a realtor in Vermont with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. Reach out to me directly. I would be happy to help you. So let's get into this article here. So what to expect on interest rates for the remainder of 2024. This is out of Forbes. So they talk about here how the Federal Reserve is expected to cut their rate by at least 25 basis points, how the Fed and the FOMC members have signaled that rate cuts will be coming at the end of September here. They reference Jerome Powell right here in this highlighted area. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. So basically, they're going to take a look at the incoming data and decide how far and how fast to cut rates moving into the future. In this Fed meeting, the indications, the words that Jerome Powell uses is going to be highly influential to whether mortgage rates stay the same, move up, or move down. Now, when we take a look at what the market is pricing in for the rest of the year, it says here fixed income markets looking at the Federal Reserve are looking at a federal funds rate reduction of 0.75% to 0.15%. So there's 3 more meetings this year. So a 75 basis point reduction in the Fed funds rate would mean a 25 basis point cut, 25, 325s. A 1.5 basis point cut would mean 350 basis points. And the Federal Reserve is going to decide on how quickly or how slowly to cut rates based on the incoming data, based on inflation's data, jobs numbers, and some more indicators that I'm sure Jerome Powell will talk about in his speech. If Jerome Powell later this month comes out and is very dovish and says, yes, the economy is slowing much faster than we anticipated, we need to cut rates faster than we thought, and we're going to start with a 50 basis point cut. We're going to take a look at the incoming data, but I think it's completely possible that another 50 basis point cut happens at the meeting after September. If that's Jerome Powell's words, we are going to see mortgage rates fall. However, if he only cuts by 25 basis points and says, the market has remained more resilient than we thought, we definitely think it's time to cut, but we're not going to jump and cut too fast. I think a pause is on the table for the next Fed funds meeting. Then we could see mortgage rates tick up slightly. Now, when we take a look at what the market is actually pricing in terms of these Fed rate cuts, we see that the market is pricing in basically a 1 out of 3 chance that there will be a 50 basis point reduction, right? Because it says here the current target rate is 5.25 to 5.5% on the overnight Fed funds rate. They're expecting there's a 2/3 chance that the Federal Reserve will drop it to between 500, or excuse me, between 5 and 5.25, and a 1 in 3 chance that they will drop it between 4.75 and 5%. So basically, those are the chances. The higher percentage is for the 25 basis point hike. The smaller percentage is for the 50 basis point hike. This is why I'm saying, regardless of what happens, if they only drop it by 25 basis points, but the Federal Reserve comes out and says we might need to pause, or they're less excited about cutting rates moving into the future, then we could see mortgage rates tick up slightly. They're not going to shoot up to 7% or anything like that, but they could go up slightly from where they are today. And that's because the market is pricing in such a high probability of a 50 basis point cut this meeting. Now, we take a look forward at the November meeting. We see here that the market is actually pricing in the Fed funds rate to be down at 4.5 to 4.75%. So that's a full rate lower than where we are today. Right now, that's 450 to 475. Oh, no, excuse me. That's 3/4 of a point. So 75 basis points lower from where we are today. So the market is pricing in the highest probability for November is that there will be one 25 basis point cut and a 150 basis point cut. So that could either come in the form of a 25 basis point rate cut in September and then a 50 in November, or vice versa. Again, if we see that 50 basis point cut and the Federal Reserve is nervous about the economy through the words that Jerome Powell says, then I think we could see 250 basis point cuts and we will see mortgage rates fall. But right now, the reason why mortgage rates have already fallen is because the market is already expecting the Fed to cut rates. They're already baking that in to the current mortgage rate. So if the Federal Reserve stays on plan, if they drop by 25 basis points, we're not going to see a huge shift in mortgage rates, right? They could go up slightly from where they are today because now there's no chance of a 50 basis points hike if they only drop it by 25 basis points, but we're not going to see mortgage rates vary one way or another. What will be more important is the CPI data that comes out on Friday, which I'll be covering on this channel, and what Jerome Powell says in regards to the outlook for the overall economy. If we take a look at where the market is pricing in the December Fed funds rate to be, so they expect it to be either a full point lower than where we are today. Again, that would be 150 basis point cut, followed by 225 basis point rate cuts, or 125 basis points lower than where we are today. So 250s and 125, or 225s and 150. Again, if we move in any direction away from what the market is currently predicting, then we're likely to see mortgage rates move. If it's only 325 basis point cuts, we could see mortgage rates remain maybe around where they are today, maybe around 6%, roughly, give or take. If they cut faster than what the market is expecting, we could see mortgage rates drop earlier. Another thing that you should be paying attention to is what the Federal Reserve is doing with their mortgage-backed securities. What this is the Federal Reserve Bank of New York, the Fed's desk. This is how many mortgage-backed securities the Federal Reserve is currently buying or selling. And, they purchase mortgage-backed securities, they keep them on their balance sheet, they sell some if they need to. For the past few years, the Federal Reserve has been reducing the size of their balance sheet. So letting the mortgages that get paid off, expire, come to fruition, and reduce the amount of their holdings. So sometimes they buy a small amount of mortgage-backed securities to keep the level of reduction at a level that they want, and sometimes they sell if the mortgage-backed securities aren't maturing enough. So they've been rolling off their balance sheet for a few months now, and we can see here what they've been doing. So the desk plans to conduct approximately $81 million in agency mortgage-backed security small value sale operations. So they're going to sell $81 million versus worth of mortgage-backed securities the week from July 29th to August 13th. If we look at the week before that, they also sold, we see here, sale operations, 81 million in small value purchase operations from May to June there. And so why they're purchasing is because too many mortgage-backed securities matured during that time period. So they wanted to buy more mortgage-backed securities to keep the size of their balance sheet stable. But why this is important for mortgage rates is because during COVID and really over the past 15 years here, the Federal Reserve was a big player in the mortgage-backed security market. That's what kept mortgages so low. The Federal Reserve was buying them. They were willing to take on this debt, the debt of people's homes, for a low rate, right? They don't really care about their return. They're not a private profit-seeking enterprise. They're not connected to the federal government, but they're not a for-profit business, right? They operate under the federal government, even though they're not a direct branch of the government. It's not a private company. So we see what they did back during the COVID pandemic in 2021 through all the stimulus. They purchased 66 billion in agency mortgage-backed securities. From February, in these 10 days, they bought 60 billion. They bought 62 billion here. So they bought a ton of mortgage-backed securities. This is where all that money printing came from, right? The Federal Reserve doesn't just print money and have all this cash. They buy mortgage-backed securities. They make money out of thin air and they purchase these mortgage-backed securities. They purchase these US treasuries, which are essentially debts owed back to them, right? Eventually, these mortgages need to be paid back. Eventually, the treasuries need to be paid back. And so it's not technically printing money, but they're essentially lending it to the US home buyer who is taking out a mortgage and borrowing against their home and the US government. Now, the reason why this is important is because mortgage rates were kept so low because the Federal Reserve was buying these mortgage-backed securities. If we go back even pre-pandemic, we see here, 2018, they were buying 6.2 billion, 2017 or 2018 again, 5.5, 6.1. So they consistently 10.9, 10 point or 11.7, 12.9. These are all these are all purchases, plans to purchase a maximum of 12.9 billion. This is what I talk about when I say the housing market has been stimulated for about 15 years now because the Federal Reserve, not only did they keep their Fed funds rate low, but they also bought mortgage-backed securities, right? Mortgage rates are dictated by the investor. What rate is somebody willing to give you their money so you can buy their home? What return does that person need to get in order to give you their money, right? Those are the investors who are buying mortgage-backed securities. Mortgage-backed securities are just a conglomerate of mortgages all bunched together, so it's less risk for people lending money, right? There's a relatively, there's a reasonable chance that one person defaults on their loan. The chances are much lower of 10,000 people all defaulting on their properties all at once. Of course, that's what we saw in 2008. We are not going to see that here in 2024. I've gone over that plenty of times on this channel. Watch my other videos if you want to know why I don't think many people are going to default on their mortgages. But regardless, looking at mortgage rates moving forward, if the Federal Reserve switches the tune of what they're doing with their balance sheet, if they're going to purchase more mortgage-backed securities and stop the balance sheet from running off, that is great for mortgage rates. We will see mortgage rates come down much faster than we would if the Federal Reserve was just cutting their Fed funds rate. Again, they haven't talked about that at all since the stimulus stopped, but it's something that they did in the past. It's something that they might do in the future, and it's something that we will be covering on this channel. So thank you so much for watching. Leave me a comment. Let me know what you think. I love learning from you folks, reading your comments and replying to you. Again, thanks for watching, and I'll see you in the next video.